Hello, thank you for watching this video. Today we're going to be doing bank reconciliation and we are going to be using the Frankwood textbook. At this point, we understand that us as a business, we get to keep a cash book which will record all the transactions of money that flows into and out of the business. So that is to say, when as a business we want to pay someone money, then we get to record that in the cash book, and then we give them the money. And then also when we receive money from other people, we get to receive that money and we record it in our cash book. However, there is some amount of money that flows through the bank. So that is, maybe we don't get to pay the person directly in cash, but we might write down a check and then give it to a person so that the person will take that check to the bank. So the bank will pay that person on our behalf. The bank will take that money from our bank account and then it will pay that person. So this is money that we paid to someone, but that was via our bank. So yeah, that was money paid through the bank. Then sometimes also we get to receive money via the bank. So that is someone who wants to pay us might also write a check to us, or they might deposit money directly into our bank account, and then the bank will let us know that we received this amount of cash, and that is also still our money. So this is just to say there are two types of money that you are seeing here. There's one which is direct cash, which we get to interact with directly as a business, and then there's also some amount of money which is transacted via the bank. So because of this, the bank also has to keep its own documents, or it has to keep its book or its version of a cash book that will record the transactions that it handles, so that we can be sure of our double entry system. So as we are recording our cash book, the bank is also recording its own cash book or its own books to make sure that its money balances out, because the bank is also its own business, and then it also has to make sure that its money balances at the end of the day. Because of this, you see maybe at the end of the month when the bank sends us their statement or their document telling us about the transactions which they did on our behalf, you see that sometimes that statement will not always be similar to the cash book that we have. So sometimes that bank statement has got a different balance from what we are expecting in the cash book. So we have to talk to the bank to see on how the monies differ. Otherwise, the balances should be equal, because this is all the businesses, or this is all our money, and we have to make sure that our money in the cash book is equivalent to the money in the bank account, because we have to be aware of our money both in the cash book and in our bank account. So that is basically it. That is why we have to reconcile that bank statement coming from the bank and the cash book that we already have, that we use daily. Let us take a look at exercise number 1 here. So this is our first example. Here you can see that in the month of December, as a business, we recorded our cash transactions in our cash book. So these are the monies that we paid and the monies that we received, and we recorded them in our cash book. So you can see here from December 1 that we started with a balance of 250, which is also the same balance that we started in the big statement. So on December, we started with a balance of 250, and then we received money from Thomas, then we received money from Jones, and then also we paid money to Gordon on 5 December, and we paid money to use on 27 December. So these are all the transactions that happened from 1 December to 31 December. Since these monies were transacted also through the bank, you can see that the bank statement also recorded these transactions in its own books. So that is to say, the bank has, let's say for the example, this 65 that we paid to Gordon, the bank takes note that we paid that 65 to Gordon, and then the $100 that we received from P. Thomas, the bank also writes down that we received that money, and the $190 from D. Jones we received. So the bank is also writing those transactions as these people go to the bank to either withdraw or to deposit the monies that they gave us. So P. Thomas and D. Jones, they went to withdraw the money, 100 and 190. These are the monies that are here. And then And then for sorry, P. Thomas and D. Jones, they deposited the money to us. So these are the deposits. Then J. Gordon and K. Hughes, they got to withdraw the monies that we paid to them, 65 and 175. And these are the monies that are written here, 65, 175. And so you can see from the starting balance that the bank also started with this balance of 250. That is because this is the month of December. So at the end of November, that is 31 November, we had reconciled the cash book and the bank statement so that the both books had an equal balance by then. So you can see how this is a fresh start. So that fresh start means that the cash book and the bank balance are reconciled and they have the same balance. So that is the 250. Then after these monies, the 65, 100, 190, 175, you can see how both the bank statement and the cash book are supposed to have the same balance. However, you can see that here we have got this $70 and this $50. So the $70 is money that was deposited into our account by P. Smith. So since it came in on 30 December, it means that maybe since it was deposited on 30 December, we hadn't gotten to like the bank. The money is still being processed into our account. So our cash book has not recorded that amount yet. Yeah, so because it also takes a few days, and as you can see, this bank statement was compiled is 31 December. So maybe it takes 3 or 5 days for the money to be processed. So the money that we received from P. Smith will be processed by the bank as if we received it, but the cash book will not be able to reflect that yet because it doesn't know that yet. And then for the bank also charged us, or it charged the account $50. This is the charges for doing transactions on our behalf. So at the end of the month, the bank will say that, oh, we did such an amount of work for you guys, so we're going to be charging you at this rate. However, we won't be like, our business won't be knowing how much the bank is going to charge us this month, so we can't foretell that it's going to be $50 still. It's only when the bank sends us the bank statement with this charge of $50 that's when we get to know, oh, like in the month of December we were charged $50. So you can see how the cash book will not be able to know the bank charges until at the end of the month. And this is very common. So in many questions that you see in bank reconciliation, usually the bank charges are not found in the cash book. So always be on the look for that you have to factor those bank charges into the cash book later. So because of the 70 and the 50, the balances at the end of 31 December are actually different. So here, our bank statement shows that it's ending with $320. However, if we see our cash book balance, we had 250 plus 100 plus 190, the amounts of money that we received, and then minus the amounts of money that we paid, that gives us $300. So our cash book is a balance of 300, and then the bank balance is a balance of 320. So these balances have to be equal because this is the same money that belongs to the business, regardless whether it's in the cash book or it's in the bank statement. So that is why at the end of each month, the bank sends us a bank statement so that we get to make sure that we account for some of the deals that it did on our behalf that we didn't know of. Yeah. So let us see how this. Let us see how this gets changed. So after receiving that bank statement, you can get to amend our cash book here. You can see that we get to actually write that, oh, we received money from P. Smith, and we also get to charge ourselves the bank charges, $50. And now our next balance is 320, which is the same balance as the bank had. So this is the bank reconciliation, the cash book being able to receive the changes that that it doesn't know of, but that are present in the bank statement. And it also works the other way around. So the bank statement might also not have some transactions that are in the cash book. That's what we'll see in our next examples. In this example, we get to see some of the we get to see an example of how sometimes the cash book has got transactions recorded that are not yet reflected in the bank statement. So as a company, we know that these transactions happened, but that the bank hasn't seen that money being transferred in or out, so it cannot record that yet. So you can see how here we start with 320 is the last balance, 320, 320, because of the last reconciliation that happened end of November. This is, we expect that these balances are always like equal. Then we get to see the other transactions that happen. So we received money 160, 140, and 470, and then $90. So you can see 160, 140, 90 are recorded, but 470 was not recorded. So that means that this is in the cash book, but it's not in the bank statement. So we have to let the bank know that later. Yeah. And then here at the here on the payment side, we get to see that we paid 110, we paid $90, and we paid 180, but the $200 that we paid to MPEC was not recorded in the bank statement, so the bank doesn't know yet that we paid this money to MPEC. So we have to also let the bank know that we paid this money to MPEC, and that is how we are going to be reconciling that's how we're going to be doing our reconciliation. So this is writing down a bank reconciliation statement, so letting the bank know that we actually paid some money to other people and we received some money from other people. Yeah. So an example of why, for example, an example of why MPEC maybe was paid money by the business, but it's not reflected yet in the bank statement. You can see how this date is January 30. So maybe we wrote a check to MPEC, but MPEC hasn't arrived yet to the bank with that check. So maybe MPEC decides to go with that check on a Monday because we gave MPEC the check on a Friday, for example. So it's up to MPEC to present that check whenever he or she wants. Yeah, because checks are also like valid for the period of time. For example, checks are usually valid maybe for 6 months or for 3 months, depending on the nature of the check. So MPEC doesn't have to deliver that check today. He or she can deliver it whatever day she wants. So since it's the end of the month, it's January 30. The bank at the end of like 31 January, it still doesn't know that MPEC was actually given this check. So that's how the cash book is recorded MPEC being paid this 200, but the bank statement does not know that. Yeah. And then for like the 470 that we saw with J Soms, well, in this case, maybe J Soms actually paid that amount to the bank because the J Soms deposited this amount. So maybe this is an amount of money, the 470 was paid to us into our account, but the bank is still processing or something like that. Like it's bank lodges. So again, the cash book knows that this happened, but the bank statement doesn't know. So it's going to be like that sometimes the cash book knows, but the bank statement does not, and then other times the bank statement does not, but the cash book knows. Okay, so this is our bank reconciliation statement. It's simply we take our cash book balance here, and then we account that there's a check that we wrote to MPEC that was not presented, so we get to edit, and then like later after getting this 800, we actually get to subtract the bank lodgement. So this is 800 minus 470, and then we get our 330. So in these examples, you will notice that I didn't get to dwell much on how to actually resolve the bank reconciliation statement because this usually differs with schools. So some schools record their bank reconciliation statements in a different way, even their cash books or bank statements in a different way. So right now I'm just explaining why things happen. And then for how to implement it, you can simply follow your school on how to implement it. So schools write it differently. Otherwise, this is actually just if you look at the numbers, you'll see there are some patterns. For example, you might not understand what this 470 is doing, but if you do not see it appearing on this side, then you know maybe later on I'm actually supposed to subtract this 470 because that's how I get that's how I get the cash book balance and the bank statement balance to actually balance out. And then you can see, I've got maybe a 110 year and a 110 year. Then you see how come this 200 is missing here when all these are the numbers, the 110, 190, and 180 are this side. So this is just you notice the patterns of what's missing and what's not. However, the way that you record it is just it differs with every school. So I will not be teaching any specific method of how to actually write that bank reconciliation statement. In our example three, we actually get to fuse the two concepts that we learned earlier together. So this is simply knowing that sometimes the bank statement has got transactions that are not recorded in the cash book, and then sometimes the cash book is the one that is transactions that are not recorded in the bank statement. So I won't dwell much on like why each transaction is happening, but it's like you can see how accounts can be easy because when you play with the numbers, like for example, 115 year is not appearing on the opposite side. So this is on the like 115 year is not appearing year, 35 year. Oh, sorry, 115 year is appearing year, 35 is appearing year. So you can see this pattern of 15, 35. So you expect this 40 to be on this side, but it's not there. And you also expect this 25 to be up here in the cash book. So you can see the bank statement does not the bank statement has a 40 which is not in the cash book, so we have to account for that. Then the cash book has got a 25 which is not in the bank statement, so we're going to deal with that later. And then here on this other side we have $80, we have 130, 130, then we've got $24 and it doesn't appear in the cash book. And then we've got $72 which doesn't appear in the bank statement, so we have to account for that 24 and the 72. So just by looking at the numbers, you can tell what numbers are missing. Then you go into your bank reconciliation statement. And so you can, again, we always start with the same balance. So here you can see you were at 160, you start with 160 after the transactions because some transactions are missing like in one book or the other. The balances at the end are not the same. So here we've got a bank reconciliation statement. This is according to the Frankfurt textbook. So maybe your school writes the bank reconciliation statement differently, or if you haven't started, you can just try to implement the Frankfurt way of writing this bank reconciliation statement. So here you can see they start with 267, which is actually the balance as per cash book. So this is after doing these transactions, the cash books gives us a balance of 267, and then we get to add bank gyro credit, like the bank gyro credit not yet entered. So we get to add our $24. This is the 24 which is here, which we didn't get to find on this other side, and then we get to subtract the $40 which was found here, but it wasn't found in the cash book. So yeah, you get to play around with the numbers. You get to follow this format. So I'm not gonna be like going line by line, but this is the format. So if you do not know how to do the bank reconciliation statement yet, you might choose the statement, or you might choose to do the way that your school usually does bank reconciliation statements. So overall, what I can just say is that with bank reconciliation statements, I saw that it usually differs with the school, but the concept is the same. It's simply making sure that at the end of all transactions, the bank statement has got the same balance as the cash book. That is because at the beginning, the both documents did not have equal knowledge about what happened on the other side. So that as a business, we knew about the transactions that happened in our cash book, but the bank is its own entity, which is not our business. On its own, on its own, when it was doing transactions on our behalf, it knows of its own transactions. So it is not fully aware of the transactions that we also implemented.